Hey, I'm Chris Perras, Chief Investment Officer with Chartered Financial Group in Houston, Texas. On Mondays, the investment team here usually publishes and distributes a brief weekend update for our clients. However, given the recent market volatility and ugly market action for the beginning of 2022, we wanted to take it a step further this week and release an update in video format. The team at Chartered has been anticipating and messaging to clients and prospects a rocky start to 2022 since early last November. Sell-offs like the ones we are currently experiencing are never fun and enjoyable. They aren't fun for you, and they aren't enjoyable for us, and almost everyone I know has their anxiety rise, including mine, and I've been doing this professionally for over 25 years. And we were forecasting this in advance. These are very normal feelings. As the team at Chartered has discussed since early November of last year, our team was expecting a market uptick in realized volatility for the first half of 2022. History from the current cycle since 2009 has shown that the early shifts in Federal Reserve monetary policies brought with it an increase in realized volatility and larger percentage declines in the indexes. Periods from 2011 through 2012, 2015 and 16, and 2018 were all periods with corrective or sloppy and choppy trading when the Federal Reserve was slowing or reducing its balance sheet. The current sell-off continues to resemble the time period of the first half of 2010 and the first half of 2018. Almost weekly, we have messaged this to our clients and prospects. Our first half 2022 outlook, released on December 3rd under the title Curb Your Enthusiasm, Yields to a Bull Market Buy, can be found in video format at this link or on our website at ocarvisfg.com. The summary of our outlook is that our team expected our first correction in the S&P 500 in the early to mid first quarter of 2022 and the cash S&P 500 index to return back to at or below its 200-day moving average, which at the time stood between 4,400 and 4,450. Year to date, the S&P 500 is down about minus 7.7%. It's down about 8.8% from its closing all-time high on January 4th. Energy, specifically old-line fossil fuels, is the only sector that is positive, with a gain of 12.8% year to date. The worst groups in the index have been consumer discretionary, down about minus 12.2%, and technology stocks down over 11%. Much of the year-to-date losses came last week, with the S&P 500 down almost 5.5% for the week. There's an old saying on Wall Street that the markets take a stair step up on a wall of worry, but an elevator down on the back of fears. That has been 100% the case year to date. On the week, consumer discretionary was down about 8.5%. Communication services, that's internet companies, were down about 7%. Financials, such as banks, were down almost 6.5%. No groups were left unscathed, but as always, on the way down, diversification helps as consumer staples, think of snack food or paper towels, was down just short of 3%, and utilities were down just under 1%. Viewers, we understand these are not enjoyable numbers. These trips south in the market are not fun, which is why, for the first time in almost 21 months, we started messaging our thoughts on a correction months ago. Recall, viewers, the data on the markets. Since 1950, the S&P 500 has had an average downturn of 13.6% over the course of a calendar year. In over 60% of all years, over the last 100 years, the S&P 500 has experienced a minus 10% drop. Think about that for a moment. In 2 out of 3 years, the market has declined minus 10%. According to the data compiled by Ben Carlson, over the last 72 years, there have been 36 double-digit corrections, 10 bear markets, and 6 recession moves. That means, on average, the S&P 500 has experienced a correction defined as minus 10% once every 2 years, a bear market defined as minus 20% once every 7 years, and a recessionary move defined as minus 30% once every 12 years. In other words, the historic data has been saying for months we were due at least for a correction in the first half of 2022. Stock markets don't go up in a straight line because the economy does not grow in a straight line either. Yes, things are worse in the growth-oriented areas of the market, such as the NASDAQ, where the markets are already down minus 15% since late November. Higher expected growth, such as many NASDAQ growth and technology stocks, come with higher volatility and higher risk in order to get higher expected returns. This brings me to the here and now, and I know the $1 trillion question. When and where will it stop? And honestly, we all know what the answer to that is. No one knows for sure, including the team at Oak Harvest. However, just as there are early warning indicators flashing in early November of last year, when our videos discussed esoteric warning signs like forward volatility curves, interest rate yield curves, and investor sentiment, many of those exact same indicators are starting to flash signs that we are nearing the beginning of the end of the move down. We'll cover some more of these in detail over the next few weeks, but those insurance salesmen that I talk a lot about in our podcast are starting to see the opportunity of selling insurance after the hurricane has already come ashore. Additionally, things like investor sentiment in the once loved NASDAQ large cap technology stocks has rapidly sunk from euphoric levels to lows not seen since the Great Recession in 2008-2009, near the lows. While there is no such thing as a perfect roadmap in the markets or a perfect compass, so far the start of 2022 has been pretty much what our team expected. A sloppy, choppy mess, which, believe it or not, is just the normal pattern of behavior and action of our markets during Federal Reserve tightening policies. It's not the new normal. The optimistic news is that if 2022 continues on the path of a more normal, albeit volatile, history indicates that 2022 is likely to end on a much better foot than it started. U.S. stocks have historically performed well during periods when the Federal Reserve has raised rates, as a growing economy tends to support corporate profits and the stock market. In fact, stocks have risen on average 9% during the 12 Fed rate hike cycles since the 1950s and delivered positive returns in 11 of those instances. Those averages would have the S&P 500 closing out the year somewhere near 5,200. Obviously, no guarantees, but that's the historic data. Viewers, no one can call tops and trade tops and bottoms in the market consistently. No one. No one can get you in and out in a riskless manner. Anyone who says they can is someone you should think seriously, skeptically about. The stock markets are about long-term expected returns, not guaranteed returns. And understanding that the market is going to have both ups and downs, learning to keep those strong negative emotional reactions in check, and always keeping an eye on your long-term financial plan are core parts of being a successful long-term investor. Which is why the whole team at Oak Harvest, not just the investment team, but our financial advisors, our planners, our company leadership, all of us is dedicated not to just investment management, but to financial planning on an individual level. We pride ourselves on meeting with you, understanding your goals, collecting and analyzing the data, and structuring a long-term financial or retirement plan with long-term asset allocation that meets your needs first and your greed second. Thank you for watching this special video format weekend update brought to you by our team. Give us a call here at 877-896-0040 to speak to one of our advisors, and let's get a holistic financial plan tailored for you and your family. So when volatility reigns in the market, you sleep just a little bit better. I'm Chris Perras, and from the whole team here at Oak Harvest, have a great week.